All right, today is Sunday, August 16th, and this is a post market review for Friday's market activities, which happened to be August the 14th. Per usual, we will start by covering the closing activities of the market, the sector's performance, the futures performance, and the options market performance. Then we will shift into the headlines. We have important headlines from Warren Buffett. And of course, we will cover the heat map analysis and the chart analysis. And before we conclude, we will look at what earnings we have for this upcoming week. And here we go. The Dow Industrial Average closing in the green by 34.70 points or 0.12%. The Nasdaq closing in the red minus 23.20 points or a decline of 0.21%. How about the S&P 500? A decline of 0.58 points or 0.02%, a muted day overall. And now, looking at the sector's performance, we are not giving any medals today because everything was muted. Of course, industrials closed at the top just by a little bit in the green, and the laggards were, of course, utilities, healthcare, and communication services. You see the muted theme also in the sector's performance. What about the futures performance? We can see that copper is outperforming now, so did natural gas, and lean hogs continuing to find a footing and a rebound from the bottom. We are seeing that the traditional gold to copper trade is taking place again. We have seen for a few weeks that copper traded along with gold. As gold surged, so did copper, but now we're seeing a little bit of a shift here where when gold declines, copper is gaining and vice versa. Of course, we just seen this for a couple of days now, so it doesn't make a trend, but we'll keep an eye on it. Speaking of gold, gold declined, so did silver, palladium, all closing in the red. We also have news from Warren Buffett, who of course opened a position in a gold miner, so that of course would affect how precious metals will trade on Monday. And now, shifting to the options market, aka the casino, we see that the Robinhoodiots crowd favorite, of course, due to the stock split, Apple and Tesla leading the option trades, calls significantly outperforming puts. But we also see Cisco here, and we've seen Cisco being bought 2 days in a row after its earnings. Cisco got whacked significantly. This is a classic mistake from amateur investors, of course, who think that anything that drops big will rebound big. That's just the natural reaction. Sometimes that happens, but most of the time it doesn't because the stock dropped for logical reasons. And of course, we've seen the gambling from Thursday's option market activities. There were over 1 million option volume traded for Apple. All of them were expiring on Friday, and they were for the strike, the call strike of 460. We know that the stock closed below 460, so all of these calls expired worthless. This is the gambling theme that we're seeing in the market, and the gamblers lost all their money on Friday, and there's more pain to come for the gambling crowd on Robinhood or just buying calls on autopilot without thinking and without any rationale involved in their decision making. And now, the most important headlines of the day. Of course, Warren Buffett dominated the day after the bell because of his very significant moves in the market. The number one headline, of course, that Warren Buffett bought gold. There's a little bit of fallacy here because I know a lot of YouTubers are creating videos saying that Warren Buffett bought gold. And that is sexy, that attracts a lot of viewers. But Warren Buffett did not buy physical gold or did not buy gold futures. He bought Barrick Gold, which is a gold mining company. It's an indirect investment in gold, yes, but it's also a little misleading to say that Warren Buffett bought actual gold. He bought about 20 million bucks worth of shares in Barrick's Gold. And the question is this a negative call for Warren Buffett on the overall market? Is he becoming more pessimistic on the market? Was that the reason behind his investment in Barrick Gold? We all know that Warren Buffett is the king of bulls. He's the most perma-bull in the market. So when he makes a move, a contrarian move into investing in gold, that will raise a lot of questions. And you will see the market on Monday being very cautious. Why did Warren Buffett buy gold? I think that Buffett is hedging. He opened a position. Yes, it's a large position for me and you, but it is a small position for Warren Buffett. It's only 20 million shares in Barrick's Gold. And of course, don't forget that this guy likes cash and he likes dividends. And when he looked at Barrick's Gold, he saw a twofer, a two-in-one. Number one, you can hedge by buying a proxy of gold. And number two, you can collect a dividend of about 1%. And the company is generating a good amount of cash. This fits and check all the boxes for Warren Buffett's decision to make an investment. Of course, we know Buffett was negative on gold for years. He made a negative statement about gold and again in the 2000s, and he said basically if people in Mars came and look at us buying gold, they would not understand what's going on. And he made very negative statements on gold over the years. So Warren Buffett now is changing his stance and he is switching to buying Barrick Gold, a proxy of the precious metal gold. And of course, that coincides with him dumping a lot of shares in banks. So when you put two together, you see that Warren Buffett is being very cautious here. He is not the perma-bull he used to be. His other moves in the portfolio, of course, dumping all shares of JP Morgan, Goldman Sachs, and Occidental Petroleum. That is gone out of the portfolio, and he cut his position in Wells Fargo. Wells Fargo is one of the worst decisions that Warren Buffett made, and now we can see that he's diluting the position. That is a vote of no confidence in Wells Fargo. But keep in mind, as he dumped JP Morgan, Wells Fargo, Goldman Sachs, the banks, he also increased his stake significantly in Bank of America. So you can't say that Warren dumped banks and he's now switching to gold. That is a fallacy. That is basically not true. Warren opened the position in Barrick's Gold, dumped the underperformers and the overvalued banks that he had in his portfolio, and now he's shifting his concentration and his investment into Bank of America. Warren Buffett is finally making the decision to choose one bank, and that is Bank of America. So why is he choosing Bank of America? Well, we know in the stress test results that Bank of America fared a lot better than Citibank and Wells Fargo and Goldman Sachs. In addition, it has a safe dividend. They have a lot of cash to cushion from any bankruptcies to come, so the dividend will be safe. They have a lot of cash and a lot of dividend, and that's what Warren Buffett likes to see. He likes getting paid dividends. And when he looks around at all the banks, he sees that the dividend in Bank of America is the safest. And when you look at the investment portfolio of Bank of America versus the rest, and we covered banks' earnings in details a few weeks ago in this channel, you can see that the riskiest investment portfolio is in Wells Fargo. The loans are very risky and they're very susceptible of default, unlike JP Morgan and Bank of America. So the question is, why is he dumping JP Morgan and solidifying all of his bank investment in Bank of America? I would say that is because of the valuation. When you look at JP Morgan, it is a little overvalued when you compare it with Bank of America. He sees Bank of America as undervalued. He sees Bank of America as a safe dividend stock. He sees their investment and loan portfolio as less risky compared to other banks. I think that Warren is also betting that we will see higher yields for a little while. And you've already seen that the 10-year yield for the treasuries and the 30-year yield have picked up from the bottom and started to rally. Of course, treasuries is just a small portion of what banks make compared to the rest of their business operation. We have the Fed funds rate, where they're, of course, depositing their money with the Fed. That is declining and will continue to decline. That is negative for banks overall. But Warren sees the value of the dividend and he likes the banking business. He made very positive statements about banks, that they return about 12% compared to the 2% that you could get from a coupon from a bond. So he is making a decision of solidifying his bank and his financial investment in Bank of America and dumping other banks. And of course, hedging that bet with buying Barrick's Gold. And among his other moves, of course, he increased his stake in Kroger by 15%. You've been following me and following my channel for a while. You know that I sold all my technology stocks back in June, and I parked all my cash in Kroger stock. I made a video about my case of buying Kroger stock. It is my largest positioning by far. I have a video. Here is the thumbnail of the video. and the video was released on the 3rd of July, I believe. I started buying Kroger and I bought more on July 8th. There was a dip in the stock and I bought and finished my position on July 8th. I made my case in that video. You can go back and watch it. But Warren Buffett agrees with me. This is a stock that is safe from all the volatility that we are about to see in the stock market. And it pays 2% dividend. It's a very safe dividend because their cash positioning is increasing significantly. They're actually increasing dividend, not cutting in this environment. And they made leaps forward in their delivery and their technology and renovations of their stores. And now, of course, they have a COVID testing kit and they're releasing a new service that competes in the online grocery shopping and delivery. So this is a company that is making many right moves all over the place, and you will see Kroger stock appreciate and the dividend increasing. This is why I parked pretty much the majority of my cash in Kroger. And now, shifting to some economic news, we have 1/3 of Americans are expected to miss their rent payment in July. Or in August, rather. They already missed in July, and now they're expecting they will miss in August. And you can see the map here with the percentage of Americans who missed the rent payment in July, and they're expecting to miss in August, and they will continue to miss in September. This is a really bad outlook. It shows the dwindling consumer purchasing power, and now we don't have the unemployment benefits like we used to before, and the PPP loan clause will expire very soon. The clause basically says that if you receive the PPP loan, you have to keep your employees on the payroll until September. That's about to expire, and we will see a wave of unemployment, a wave of new unemployment hitting the market, more missed payments, more delinquencies. This is not good for the real estate businesses, not good for landlords, because landlords right now cannot evict the renter. And you see the pain in the overall picture here that people are suffering from the economic woes of this pandemic. Speaking of suffering, what about the 1%? What about the super rich? Are they suffering as well? No, they're not suffering. The super rich are calling the virus the poor person's virus. They're having a great time. They're buying properties. And we're seeing the luxury housing market rebound because the richest people right now, this is open season for them. They're bargain hunting. They're buying houses all over the place and they're accumulating property. As the poor and the middle class houses and properties get foreclosed, the richest people accumulate them and become richer in the process. And this is how the rich becomes richer and the poor becomes poorer. They're scooping properties all over the place. This is the environment that the Fed has created, inflating the prices of assets to benefit the wealthy while the poor and the middle class suffer. And this is the result. Big business absorbs small business and the rich absorbs the assets of the poor and the middle class. It's a country of the haves and the have-nots. And speaking of the Fed, here is the Kaplan from the Fed saying that the Fed is expected to let inflation rise above the 2% target. How is that good for our economy right now in the middle of the recession, when we see consumer purchasing power dwindling, when we see more unemployment, when we see more suffering and people cannot pay the rents, and the Fed is thinking about increasing inflation and increasing the everyday prices that consumers who are already suffering pay for. When you have a recession, when you have a dwindling consumer purchasing power, when you have a crash in the GDP, the worst GDP drop that we've ever seen, and when you have high unemployment that is probably going to stick for a while, increasing inflation is a recipe for a phenomenon called stagflation. That happened back in the 70s, and the 70s was not a good decade. You can look at the stock market, it was flat, it didn't do anything during the 70s. A lot of people slipped into poverty, and this will happen in a worse magnitude if the Fed really goes with their plan to increase inflation. It will cause one of the worst stagflation periods in American history. The Fed lost their mind, and they have no clue what they're doing right now. After pumping all the liquidity in the market, the trillions of dollars, to inflate assets, they failed to inflate the consumer price index in the real economy, and now they're planning to do that by further cuts in interest rates and further liquidity. All of what this does is increasing the asset prices for the wealthy who hold stocks and real estate, and it makes life harder for the poor and middle class because their everyday purchases will cost them more. And then we know that their wages are not increasing and haven't been increasing for a while. So how is that good for the average American? Now, shifting to the international stage, we have Colombia, the country of Colombia experiencing its worst crash in record, the worst economic crash in record. We've seen that from the UK earlier in the week. We have seen it in the Philippines with the worst economic crash ever. This is the global trend. We're seeing a massive drop in GDP worldwide, yet somehow we're supposed to buy stocks because they only go up and they will benefit from the recovery, quote unquote, in the global economy. It will take years and years for these countries to recover. They don't have the Fed. They cannot print money out of thin air to get out of their problems. It will stick for years to come, and there will be more suffering in the global economic arena. And of course, we've heard news about the deal of the US selling Taiwan 66 F-16 jets. That, of course, got under China's nerves, and China is not happy about this purchase. The tension and the political tensions between the US and China will increase significantly in the days and weeks to come, and this will not be good for the stock market. So if you're discounting the risk of China-US escalation, you need to rethink your strategy. China is preparing for a hit back. They're preparing for a strike, for revenge, but they will time it accordingly. They will time it when it hurt the most, and that would be closer to the election. They're not happy with what we did with TikTok and Tencent, and now with this deal of selling Taiwan F-16 jets, they will strike back. You can bet on that. And of course, speaking of individual companies and Chinese companies here, iQIYI, I think this is how you pronounce it. It is called or dubbed as the Netflix of China, and it's very popular with young investors here in the United States. This stock dropped significantly during the trading day on Friday on a SEC probe for fraud allegations that they are inflating the revenue numbers. Here's of course the reason why I don't invest in Chinese companies, not even Alibaba, because they release the numbers in renminbi overnight, and there is no way for us to validate whether these numbers are right or wrong. We've seen that with Lunkin Coffee, and I don't know why the government allows Chinese companies to IPO here in the US, raise cash from US investors, and go back home to work on how to destroy American businesses. And of course, the victims, when we see fraud like this with iQIYI or Lunkin Coffee, the victims are American investors. We need to add more scrutiny and more regulations on any Chinese IPOs to protect retail investors from being victims of fraud. And here is another news for the Apple saga. We've been following what happened with Fortnite, turning up the heat on Apple. Apple is, of course, a company that turned to the mob business. They don't have growth in iPhones or any of their hardware business, and now their services revenue is trending negative. So what are they doing? They're shaking down app developers for more cash. They want 30% cut of your overall revenue from the App Store. Fortnite tapped out, said this is not good. They tried to circumvent Apple. Apple punished them by kicking him out of the Apple Store. And now Fortnite is standing for the little guy, taking the heat and raising the issue that the government failed to raise of the monopoly in the App Store business from Apple and Google. Fortnite hit, and now we see more companies like Spotify, and here you go, Facebook joining the fight against Apple, saying that this is unfair and it hinders all the innovation and it acts as a monopoly for the application's business. So expect more scrutiny and more heat against Apple here. And I don't know, the people who are still buying Apple due to the stock split, they're of course zombified traders. They have no clue what they're doing. They're programmed on autopilot. They think that the stock split somehow will make them richer, ignoring all of these factors of companies raising heat against the highest margin business of Apple's revenues. And of course, we know the tensions between the US and China. The question is, when will China strike against Apple? That is another risk that investors, and I say that in quote unquote investors because they're not investors, they're gamblers. They're ignoring all these threats and they're just buying on a blindfold, buying Apple stock, waiting for the stock split, the revelation of the stock split when they will become richer overnight. Stock splits change nothing at all. There's a lot of risk now built up in Apple's shares. The valuation's too high, the technicals are bad, are stretched out, and now you have this fight against Apple from Facebook and other companies. You bet that will take effect and will hammer the stock price. Yet the gamblers continue to buy calls on Apple. They continue to buy it. We saw that the gamblers lost their money on Friday betting on calls. Over 1 million options. Poof, gone, lost. And they will continue to do that until they lose all their money. And now, shifting to COVID news. We have news that the COVID antibodies that you produce naturally after being infected with the disease last for only 3 months. This is a significant development because it has implications on the upcoming vaccine. If your own body's antibodies last for only 3 months, you can bet the vaccine antibodies will last for less than that, meaning that we will have to take the vaccine periodically every 2 weeks or every week or every month. It depends on the efficacy and the age of the patient. And this is another way for pharmaceutical companies to juice people for cash. Now you will have to be addicted to this vaccine. Otherwise, you will get infected. You will not be allowed to go out and about. My question here, if the vaccine has to be done periodically, meaning you have to take a shot every 2 weeks, who's going to track that? How do we know that person X is up to his or her vaccination right now? Are they going to track it by phone? Are they going to track it by what vehicle? Are they going to track people's vaccinations record? This will raise a lot of questions, and we know that the freedom-loving Americans will be against this idea of tracking people's vaccination record and perhaps banning them from entering properties if they're not up to their vaccinations. Who knows? But it raises a lot of questions about the upcoming vaccine and how it will be administered. Make no mistake, the vaccine is coming because it is a political tool. The president allocated billions of dollars to pharmaceutical companies. Some of them are very speculative, like Moderna and Novavax. And executives from these companies dumped a lot of shares and became richer in the process. Now they owe the president a favor. That favor is releasing the vaccine prior to the election to help his re-election prospects. So make no mistake, the vaccine is coming, and this is why we are playing the rotation game. We will talk about that in a little bit. But before we do that, here's another proof that the vaccine is coming very soon. McKesson has a deal with the government now to distribute the vaccine from the Operation Warp Speed. So they're setting the infrastructure now for the distribution. The vaccine is coming imminently, and it will have huge implications in the stock market, specifically the rotation trade. Speaking of the rotation trade, here we go. Here is the heat map, and you can see the muted action. There is nothing to look at here, so we will shift right away to the rotation trade and my personal picks of how to play the rotation. You see in your left-hand side are the former winners that benefited from the stay-at-home culture and their stocks flew really high, versus on your right-hand side, the losers whose stocks got really hit during the COVID correction and they haven't recovered fully yet. We are seeing a rotation from the winners to the losers. The winners, we used to call them momentum before. Now we're going to call them garbage stocks because they will be dumped fast. And of course, we will call the losers, we used to call them the garbage stocks. Now we will call them the comeback stocks. And you can see that I added Six Flags to the comeback stocks and I added Papa John's to the garbage stocks. We've been tracking this rotation for a while and we tracked them this week. Here is the scoreboard for the week. You can see that the comeback stocks overperform the garbage stocks. And again, we will do this every week, perhaps every day, to track and see whether the rotation is for real and if it is sustainable or not. Make no mistake, this is not an invitation for you to go ahead and shop and drop money like a drunken sailor buying all these stocks. The key word here is nibble, small positions, or better yet, wait till the signal. I gave you a technical signal in my video from the rotation shift. I made a video a few days ago in details going through explaining how the rotation is happening and what technical signal you need to look at to confirm it. And we will revisit that in this video during the technical analysis, so stay tuned. For me personally, I have positions in the comeback stocks and I have short positions in the garbage stocks, but all of these positions are small. They are starting positions, they are nibbling positions. We're not going all in yet. We need to see confirmation and we need to wait if there is an overall correction in the market or not. Because if we have an overall correction in the market, all of these names will get hit together. The garbage stocks and the comeback stocks, but the comeback stocks will fare better and they will rebound better than the tech stocks, aka the winners, aka now the garbage stocks. So we'll continue to track this. For me personally, I have a long position from, of course, the comeback stocks in Chevron, Mondelez, and Cisco. I've released this tweet, of course, explaining when I bought Cisco. All my trades are publicly announced on Twitter. And I have, of course, a position in Disney. I converted or I exercised my option positions. I bought shares of Disney at the price of $120. And of course, when we look at the garbage stocks, I have shorts in Apple, Peloton, and I released this tweet when I started my short in Peloton and Papa John's. I started that position on Friday. Here is the tweet of me announcing that trade. I had a short in Tesla that I closed before the announcement of the stock split. And of course, I'm waiting now after the split when the put options become really cheap. I will start another short position in Tesla via put options. And I'm of course looking for short positions in Clorox, perhaps next week, and Nvidia. Nvidia's reporting earnings, so we might have a put spread here on Nvidia, but I still haven't made a final decision yet. This is all nibbling. These are all small opening positions. I am still waiting for a confirmation to go in heavy in these moves. And you should be too. Be careful. Don't go all in and then be surprised that a different outcome happened. We're still tracking the rotation and making sure whether it's sustainable or not. And now, switching to the charts analysis, here is a weekly chart of the SPY. You can see that we still have room to go. We can go a little more higher, defeating all-time high. We are making this pin look right now of indecision this week, but we can charge upward and beat all-time high. The MACD tells us that there's still room for the SPY to go, and the RSI, of course, tells us that there is still room for the SPY to beat all-time high. When we switch to the daily chart, you can see that the chart is doing this gathering, consolidating pattern below all-time high. Where did we see that before? We've seen that behavior before, a breakdown a little bit, and then a consolidation and gathering of energy during the last resistance, now support line. The SPY got rejected, and it gathered energy, consolidated, and then finally broke through. Is it doing the same thing here with all-time high? It got rejected for a little bit, it reversed, and now it's consolidating, gathering more energy for the break above all-time high. Certainly possible, but the question here from the bear side is, why didn't the SPY do it already? Why didn't the SPY break above all-time high when it had all the favorable conditions that it had, with stock splits, manias, and low volume during August, where the retail traders dominate the game, and retail traders are bulls. They buy stocks and calls mostly. Very few of them buy puts or short stocks. So why didn't the SPY already break through all-time high? That is a very important question, and it raises the warning flag that maybe the SPY is weakening at this point. It doesn't have the spark and the steam to break over all-time high right now. Shifting to the Qs, the Nasdaq, we can see from the daily chart that the trend is still intact. Until we break the trend, the Qs are still positive, still bullish. Once we see the break, that will be very, very negative, and it will trigger a waterfall and a tsunami of a sell off in the Qs, because these technology names are the most held stocks right now. So when somebody presses the button and sells and trigger another sell, you can see the domino effect snowballing, and you can see a really bad sell-off in the Qs. How about from a weekly perspective? Remember the sign that I've been telling you about that you have to wait for the switch for the rotation? Here it is, the weekly chart of the Qs or the Nasdaq. You look at the MACD. The MACD is curling down, but it hasn't crossed the blue line yet, which is the average. Once it crosses the blue line, that would be the signal for shorting the Qs and perhaps the rotation. But that would be an early signal. If you want to stay in the safe side, You have to wait for the MACD to turn negative and start making red impressions. That would be, if you want to be in the safe side 100%, that would be your signal. But a lot of professional traders will wait until the cross of the blue line and they will start shorting the Qs. Likewise, we see the RSI curling down without reaching the former high. This is a negative piece of information when you look at the weekly chart of the Qs. And now let's shift to the VIX. We haven't talked about the VIX for a while. You can see that the VIX refuses to go down to its former levels and former lows, even though we're making almost all-time high in the market. Why is the VIX refusing to go down to its former lows? Why is it hanging out here, waiting and waiting and waiting? You can say, this is a very logical argument, that the VIX is waiting for a big, massive pop. And we know historically that August had a pop in volatility the last 3 years. Here it is in 2019. And if you scroll back and you go back all the way to 2018, here it is, a pop in the VIX during August. And when you scroll and you go back to 2017, here it is, a pop again in the VIX during August. Will the pattern continue this year and this time around? I say yes, because we are also happen to be in an election year. Things will become very, very volatile. I made a video a few days ago arguing that you should prepare for a massive surge in volatility, and the VIX will surge during August. That is my bet, and it will continue to surge in September. We are heading at the second half of August now. The first half, where the retail traders dominate the market, you have very low volume. Now we're going to the second half of August, where some professional traders start to come back to the market. In September, the majority of them will come back. They will look at the market, seeing it all-time high, all these stretch valuations, and you bet that there will be a big percentage of these traders and these investment firms pressing the sell button, taking their profits because they don't want to go into the volatility of the election year. And now, with the final chart, we will look at the ES Mini, the S&P 500 futures. I've been telling you that this box of the box of the movement that we've been in since June looks eerily similar to the box that we have formed in February before the crash. It pretty much looks like if you put a magnifying glass on the move in February, you get the look that we have right now in the market. Will it end the same way? Will history repeat itself and the chart will turn negative and we have a steep sell-off like we have seen in February? That is the question. The question is, are we going to break through all-time high, or are we going to do the double top? To me, it doesn't matter whether we reverse from double top or after the break of the all-time high. It doesn't matter to me. From my perspective and my opinion, I think that this consolidation and this formation of the market that we have seen since June will end the same way the formation from February ended. It will end in a massive, steep correction. That is my bet. That is my analysis that I've been arguing for a while now. So when the market flips and starts trading in the red and corrects significantly, don't say that the signs and the signals weren't in the writing right in front of you, because the hint was right there. The box that we're in right now looks exactly the same as the box that we have formed in February. The sign and the signal is there right in front of you. And there's, of course, psychological reasons behind the formation, behind this formation being a very bad formation. You can see an early rejection, and then you can see the double bottom, and then a consolidation inviting weaker hands to push the market higher. Once the weaker hands push the market higher, you see these little dots, little movements of green every day gapping up during low volume. And then as the market becomes very stretched, you see the early entrants in the market who are already holding positions saying, okay, that's enough time to take profit. And once they click the sell button, they start the red waterfall and they bury all these late entrants in the market very fast. Within days, they will lose everything they've gained. It's the psychological game of bigger traders inviting smaller traders, telling them the water is warm, everything is great, come over, push our holdings a little higher before we pull the plug and bury you, because we have to sell our holdings to someone. For each seller, there's a buyer. This is how the market works. And before we conclude this video, let's look at what we have this upcoming week. We do have earnings. We are through with the majority and most important earnings, of course, but there are some important earnings this week, so let's take a look at them. On Tuesday, we have Home Depot and Walmart. On Wednesday, we do have Target, Lowe's, Nvidia, and TJ Maxx. And on Thursday, we have Alibaba and Ross. Of course, Home Depot, Walmart, Lowe's, these are names that benefited during the pandemic closure and they rallied really high. They're all-time high. So it is judgment day for them. Are the gains that they have scored during the lockdown sustainable or not? This is the question. What about Nvidia? Nvidia, of course, we've seen, as with other semiconductor stocks, that the trend is higher, and you will see that for this quarter the revenues will be very impressive, specifically from the gaming segment and from the data center segment. The question though is, the stock flew really high. The stock is almost up 100% year to date. Is it already pricing in whatever good news that the earnings will reveal? That of course will crash the stock and will cause a sell-off. Or will the earnings be so good in the guidance here? The most important thing here in this earnings report for Nvidia is the guidance. If the guidance comes out saying yes, the positive picture will continue for next quarter and perhaps to the end of the year, and the stock is not pricing how good the story is yet, you can see Nvidia rallying. But I would say that the stock is very stretched now. You don't see stocks going 100% year to date in the environment we're in right now, and that's being justified. I expect a pullback in Nvidia shares after the report. What about TJ Maxx? This is a name in our comeback stock, so we want to wait for its earnings. We want to see confirmation the business is picking up again so we can buy shares in this name. However, the name ran really high in the last 2 weeks. So ideally, you want to see a good earnings report identifying a bottom and a turnout in business. The business is increasing and picking up again in TJ Maxx. Yet we see a sell-off in the stock itself. That would be an opportunity to accumulate and to open a position in TJ Maxx. What about Alibaba? We talked about Chinese companies. We absolutely have no clue what they're going to report here, and you just have to take their number for what it is. Ross, another story, just like TJ Maxx. It's a name that could be added in the comeback stock. We added TJ Maxx as in lieu of all the retail and clothing retailers, but Ross is another name that we are waiting for the turn and the comeback. So we will see whether their business from the report is picking up and coming back and accelerating again or not. Again, very exciting week. We have few earnings, but we also have few important developments with Apple, this whole fight against Apple. We do have Warren Buffett's recent moves. That will have implications on the opening in Monday. We also have a lot of stretch valuations, important technical milestones like all-time high in the SPY. It will be a very exciting week and very decisive week. We want to watch if the volume starts to tick back up. There are more professional traders coming back to balance all the mania that the Robin Hood idiots and the amateur traders did the last 2 weeks of stampeding in stock splits and speculative names. We could see that balance, and that balance will not be very good for these names because we could see a decline in the market. But we have to see. There are so many factors, and this week will be extremely important. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.